Right, let's get the outlook for European equities. Andrew Popper is Managing Director and Global Strategist at Beauclerc Advisory Services. He joins us now. Hi, Andrew.
Good morning.
More of the same next year when it comes to those gains for each stock market across the regions? What do you reckon?
Certainly what one would hope so.
Yeah.
This year was an interesting one. It didn't really feel it was such a good year, but because we had all the ups and downs and anxiety and so on. But now that we're closing the year, we're seeing very, very good results. And certainly one would be very happy to see a repeat of the same next year. I think that the premises are in place for having a decent year in equities next year. We have, when we discussed here and elsewhere, we said that there were three major risks. First, certainly the Eurozone crisis. Second, the risk of a hard landing in China. And third, the fiscal cliff in the US. Now, we are sitting here at the end of the year with two of the issues, at least for the time being, out of the way.
Yeah.
The European situation has been resolved, at least for the time being.
Yeah.
There is no risk of hard landing in China.
Yeah.
We're seeing good numbers coming out of China. And what is remaining is the fiscal cliff, which I'm not trying to belittle. It is an important problem and it's far from being solved. However, if we get this out of the way, then we have the conditions in place, especially in the US, for a strong recovery of the economy. One should not forget that first, we have a lot of good numbers coming out of the US, especially from the housing market, which is very important. Enormous progress has been made in deleveraging the economy, so the base is in place for a strong recovery. And then second, you're looking at a corporate balance sheet where people are sitting on a lot of cash. So there is a lot of room. If investor confidence is recovered, if consumer confidence gets better, there is a lot of room for investment-led recovery in the US, which could be quite strong.
But Andrew, on the European issue, you say, and obviously European stocks have re-rated, but do we have a valuation concern here or not?
Well, certainly, if you look at where, first of all, before responding directly to your question, we have to mention that it's extraordinary what happened to European stocks. They were lagging 10% behind the US stocks in the summer.
And then Draghi came out and changed the game.
And now we're ending the year with the European stocks actually outperforming the US stocks, which is somewhat surprising. Now, are they overvalued now? I don't think so yet. There is still a significant premium because of the macro situation. There is still a prevalent premium on European equities. So there has been an adjustment in European markets in the expectations of earnings per share. Now they are far more realistic. They are reflected in the current prices. And considering the premium that still one has to pay for equities, I don't think that they are overvalued at this stage. So we still have room for significant improvement in the equity markets in Europe, provided that everything remains in place.
And Mario Monti's resignation, although he was going to leave anyway in a few months, Andrew, does that highlight the fragility of the political situation in Europe?
Well, I don't think that specifically this resignation should have a major impact. It was expected. It's perhaps anticipated by a couple of months. We knew that Mr. Monti was going to leave. He certainly did very important things for Italy, very important reforms. We saw the market reaction was very, very favorable. But one should not forget that he still lacked the legitimacy that comes to being elected. So it's quite a normal process in a democratic country for him to step down and let the political forces come back to the fore and fight an election. Whether that will be in February or a little bit later, one remains to see. Probably the center-left coalition will come to power.
And they'll carry on his austerity measures.
Carry on the austerity measures.
Let's talk asset allocation. Prepare to shift to high beta stocks, you say, including emerging market stocks.
That's right. Right now, and until now, we have been rather conservative because we expected, we had a correction this quarter, then we expected a phase of consolidation. So our asset allocation to equities is still not as high as it should be. And it's highly concentrated in U.S. high dividend stocks, which have a defensive characteristic. However, if we manage to get this fiscal cliff out of the way, we are getting ready to shift our asset allocation more to high beta stocks, both in the US and in Europe. And in Europe, we are still looking for undervalued stocks.
You're making a big call, aren't you, on telecoms and utilities, two of the underperformers of 2012.
Yes.
You say they might have their day.
That's right.
Their day in the sun.
That's right. We think that we called 2013 already the year of the underdog.
Yeah.
And we think that the stocks that underperformed utilities, telecoms in Europe have a reasonable chance to perform next year. Another significant question is, where is the money going to come from?
Yes.
And in our view, we should be more cautious about bonds.
Right.
I think that one is, when talking about bonds, is always at risk of crying wolf once again. Because many people have been concerned about the bond market, about inflationary expectations that did not materialize. But I think that we have come to a very low level of interest rates. Also, very importantly, the corporate spreads to sovereign have narrowed very, very significantly, that we are approaching the moment when this prediction about a correction in the bond market is becoming more and more likely to materialize. So our concern is twofold. First, that the inflationary expectations will begin to rise, which will lead to a correction in the bond market in general, in terms of affecting bonds, in terms of duration risk and so on. And the second element that is very important is that the corporates are already trading at very, very narrow spreads. So there is not the cushion that we had before when sovereigns declined. We didn't see a major correction necessarily in the corporate market because the spreads narrowed. Now the spreads are already very, very narrow. So if we see a correction in the sovereigns, corporates will be affected, so it will be a broad-based correction.
Watch out for that. Andrew, thank you very much for chatting to us today. Andrew Popper, their Managing Director and Global Strategist at Beauclerc Advisory Services.